In this week's update, precious metals on a big time roll, where the emphatic winners are, what is working and what is not. My name's Garry Davis, and as always, this is general advice only. And remember to subscribe and like the video. So let's just have a look at the general backdrop to markets at the moment, because so much has changed in the last 3 or 4 months. It's quite extraordinary, and if you really look under the hood of the market, not just at the indexes, it's really evident that we've got a tremendously bifurcated market. They're certainly not uniform by any stretch of the imagination. We've got some really, really strong bull markets going on in certain sectors and industry groups, but we've also got severe bear markets going on, and it's happening at the same time. If you wind back 10 or 20 years, markets tended to go up, and you may have heard the expression, a rising tide lifts all boats. Now that didn't apply all the time, but it certainly did have quite an impact across the market. But that is definitely not the case now. We are absolutely in a market of winners and losers, and you need to make sure that you're on the right side of the equation. So don't just look at the index to make decisions about what you're going to do. If the S&P or the Dow Jones goes above or below a certain support or resistance level, then you're going to do X. That's just the wrong way to look at the market these days. It's completely misleading. It's just irrelevant information. Overall, the price action, as I read it, has got to have a bullish bias, and let me explain why. Money is flowing into the aggressive sectors. Money is not flowing into defensives. It's not going into utilities and real estate trusts and the normal sorts of areas. It's going into technology. It's going into consumer discretionary, amazingly. And I'm talking America here, but similar things will apply in Australia. And it's going into consumer services as well. So these are all risk-on sections of the market. It's going into biotechnology. Where it's not going is the defensive groups that I mentioned. So you can only conclude that there is definitely a bullish bias to this market. There is a risk-on attitude for sure. So what should you be looking at? And I cover this extensively in Portfolio Analyst and in the Insiders Club. But you need to be looking at sectors that have got enduring growth for the next 5 years. Sectors that are going to grow no matter what central banks do, no matter what China does, no matter what Trump decides. These sectors are going to march on regardless. And they're fairly easy to identify. Secondly, so if you're looking at sectors, if you're looking at good companies in sectors that don't have enduring growth, then you're just wasting your time. So really focus in on those growth areas. The next thing to do is to make sure that the companies within those growth sectors have got the balance sheet strength and the cash flows to get through whatever the impacts of this global lockdown will be. And who knows? It's incredibly uncertain. We don't know how deep the impacts are going to be and how long they're going to last. So you've got to make sure that the companies are well and truly strong enough to get through whatever is ahead of us over the next 6, 12, 24 months. Most importantly, you need to be looking for technical outperformance. You need to be backing the stocks that are at strength. Now, I know that this goes against our natural instincts. Our natural instincts are to try and buy low, buy cheap. If the department store's got a sale on, everyone goes down to buy. You don't rush to the department store when they announce that they've just put their prices up 50%. Yet in the market, that's actually what you want to be doing at the moment. You want to be backing the strongest stocks, because the strongest stocks are going to get stronger. And it's really being driven, particularly in the US, more than here. But in the US, there is the self-interest of fund managers. If they are not in, and their performance is assessed every quarter, if they're in sectors that are lagging the S&P, or they're not in sectors that are outperforming the S&P, then people are going to take their money away from those fund managers and put it somewhere else. So there's a huge amount of self-interest here for fund managers to keep rotating into the sectors that are leading. And so, why shouldn't we? Trying to pick stocks that are out of favour and hoping they'll turn around is just a wasted effort. So that leads me to the point of the reality of trying to pick turnarounds. It's a low probability game. Yes, you will pick it. You will pick some good results, but you're also going to pick an awful lot of lemons. And the results that you do get right, which will be in the minority, are possibly going to take 6, 12 months or more to deliver. Now, I've had people say to me, well, look, I'm investing for the long term, so I don't care. But why not take the performance now while it's available? Why not be in the strongest sectors? Why would you be happy to park your money in a sector that's perhaps going nowhere for the next 12 months when you could be in a sector that is going great guns? Then we get to the point of how do we do it? Well, there's a lot to this, and I explain this in great detail in the subscription services. But basically, if you've got a very strong group, don't expect too much of a pullback. You need to be prepared to buy into mild weakness, because that strength is just going to continue. The normal blueprints, the normal relationships are just not applying anymore. So if you're sort of clinging on to the old ways of doing things, then you really need to rethink how you engage with the market, because it has changed quite a lot. So that's the backdrop. Let's look at American stocks. For the record, the S&P fell 1.5%, and the Nasdaq fell 0.7%. But if you look into the industry groups, beg pardon, within those indices, there is an enormous divergence in performance. I think we're likely to see continued consolidation at the index level, but we are already seeing since before the crash, because some stocks hardly crashed at all. So we've seen some incredible strength with individual stocks, and that's got a lot of people scratching their head as to why that is. There's a number of factors to it. One of the factors is that some industry groups are actually better off because of the lockdown. You think about home improvement stocks. You think about all the people that are now remotely working in the internet stocks. You think about software stocks. There's a number of parts of the economy. Consumer discretionary purchases online have done outrageously well. So some sectors and some companies have benefited enormously. So their earnings have gone up. And if you look at the FANG stocks, I think over the last quarter, their average earnings has gone up by 14%, or their average revenue. I might have got that back to front. But certainly there has been a dramatic improvement. This has been a great environment for those stocks. So that's one reason. The second reason, which is sort of looking at the market on a bit more of a broad base, is that before this lockdown, the earnings yield, so not the dividend yield, but the earnings yield of the S&P, the average S&P stock, was about 6%. Now, even if, and those earnings on average will come down, and probably quite sharply, but even if they came down to 3 or 4%, then you look at that beats the pants off the bond yields at very, very low levels. I think it's about it's about 0.64, I think, for the 10-year yield. So you can buy a government bond and get 0.64% for 10 years, or you can be involved in the average S&P 500 stock and get an earnings yield of 3 or 4%. Which would you choose? I mean, it's pretty obvious. So that is causing money to support the market. And a lot of people are saying, well, the valuations are now ridiculous. Well, valuations don't matter as much, but we also need to remember that there is a great deal of money that's sitting on the sideline, that's seeking a better return, and that there is just straight out a better return in stocks than there are in bonds. And the other factor is that valuations rise as interest rates fall. So when interest rates are effectively zero, then valuations by definition have to rise. My view is that economies, and it's happening already, and hopefully it continues, but economies have to reopen now, otherwise we're going to be in a depression that might make the 1930s look pedestrian. So it's got to happen, and happen very, very soon. Now the US dollar was higher, edged up about 1 cent over the week, and the 10-year yield was steady at 0.64. So let's jump in and take a look at some charts. So we'll start with the NASDAQ first of all. So we've been looking at the outperformance of the NASDAQ, and the NASDAQ, I guess, has a much greater concentration of technology stocks, which is one of the leading sectors. And so that's why the NASDAQ has done so much better than the S&P has done. So you can see we've gone all the way through all the Fibonacci levels, and we're not that far off the all-time highs from February. All we're seeing all the way along the line is very mild pullbacks, only lasting a couple of days. A couple of days there, a couple of days here, a couple of days here. And if we look at the bottom window, look at the outperformance of the NASDAQ compared to the S&P. So where are the fund managers going to put their money? They're going to put it in more NASDAQ listed stocks than they are in the general S&P index. Now, for the record, there's the S&P index. So we've managed to make it to the 61.8, but it's struggling at the index level. But just remember that there is incredible divergence underneath. And let me just point to some of that divergence. So if we look at the US, this is a stock called ServiceNow, which is a technology stock. So all I want you to do is to look at the red moving average line, which is the 200-day moving average, and the blue 50-day moving average line. Look at how they're orientated, one on top of the other, the direction that they're heading, which is upwards, and look where the price is relative to those moving averages. So that's a very, very powerful price trend. On the other hand, let's look at airlines. This is Delta Airlines. Look at where the price is relative to those moving averages. Would you rather be in a stock that's doing that? Or would you rather be in a stock that's doing that? And I'm getting questions from various sources that are asking me about buying airlines, buying travel stocks. I mean, why would you try and pick something like that just because it might be a turnaround and it might give you a nice big fat return? But you've got to remember that history shows that most turnarounds don't actually work. So again, do you want to be on something like that, or do you want to be on something like that? Let's look in the Australian sphere. Here's Qantas compared to A2 Milk. Which one would you rather own? Which one would you rather be in? So it's pretty stark. And if we look at the sector level, again, just to reinforce, this is in America. This is the XLF, which is the finance sector in America. It just continues to be under enormous pressure. Compare that with the biotechnology ETF. So it's really chalk and cheese. And there's the technology ETF. So my very, very clear message is stay with the sectors that are doing well, both fundamentally and technically, because that's just where the profits are. There's the US dollar index, so just hovering slightly above 100, but it basically in a zone of consolidation. And if we look at the Australian dollar, so the Australian dollar has certainly shown some relative strength. It's gone up more than the US dollar has gone sideways. Whether that is sustainable or not remains to be seen. At the moment, the 200-day moving average is still pointing down and the price is still below it. So by definition, the Australian dollar is still in downtrend. All right, turning to Aussie stocks now. The Aussie dollar fell a little bit across the week, but it was pretty much in line over the week with what the US dollar was doing. Now the ASX 200 index was basically flat, rose a couple of points, and the risk-on attitude, it's not here yet in the same way that it is in the States, but it's finding its way into our market. We certainly lack some of the industry groups that the US has got, particularly in technology and healthcare. But similar themes will play out here as well. So let's just quickly look at the ASX 200. So you can see we're stuck. We're stuck at the 38.2% level, and that's largely because of energy in the banks are really what's holding our index back. All right, let's move on to precious metals, because this is where the action, or one of the areas where the action has been. Gold had a really, really strong week, was up $40, finished at 1744, so it continues to work its way strongly higher. Silver did even better on percentage terms, and it's definitely starting to play catch up, which is a theme I've been talking about for the last couple of weeks. So gold has broken out from a triangle consolidation, so I think we're now embarking on another surge in the gold price. And if we look at precious metal stocks, GDX had a very powerful week as well, continued with its breakout, and many smaller producers are now joining in a massive way. And on Friday night, I've got a watch list of US gold and silver stocks, and more than half of them went up by between 10 and 20% just on Friday night. So that was a huge move in the market. So let's take a look at precious metals. So first of all, on a daily chart, so you can see here was the triangular consolidation that has been happening in gold since the middle of April, and we broke out of that consolidation on Friday night. So that's a very, very positive sign, and that will bring, by definition, that will bring more money into the market. Looked at on a weekly, we're still in a very, very steep upward sloping channel. We're getting towards the top of that channel, but when you pan back, there's the peak in 2011. So we're closing in again very rapidly now on the all-time highs. And if you extended that forward, then, and it won't necessarily go this way, but we could certainly be at the all-time highs at this current rate of increase. We'd be at the all-time highs by the end of this year. So very, very strong move. There's silver. You can see silver. This is a daily chart. So silver also broke out with a huge momentum out of that consolidation triangle on Friday night. And that's what really got some of the silver stocks in the US going. If we look at the spread, actually got a couple of spread charts here. So this is the ratio between gold and GDX. So this is showing that this rise here is showing that GDX is outperforming the gold price. So this is one divided by the other. So that's rising very, very quickly. So gold is starting to play catch up. GDX is starting to play catch up with gold, and silver is starting to play catch up with both of them as well. And I just need to find the other, the other spread chart, which shows the ratio with silver. There it is. Okay, so this is the gold price divided by the silver price. Norm is somewhere around the 50 to 60 area. We got up to 124 times, so gold was 124 times more expensive than silver. But you can see that line, that ratio line, is now coming down very, very quickly. So silver is starting to really catch fire. So lots of very good things happening in that space. And if we look at some of the, and these aren't recommendations, this is just to show you the move in some of these US gold stocks. So again, please do not seize on these as companies that you should buy. They're just being shown for illustrative purposes. So I just want you to look at the move. Don't worry about the name. So look at the move on Friday. Look at the volume behind it. That one, huge move on big volume. Same with that one. It's the same pattern all the way through. So we're well and truly underway on precious metals. And in this environment, I really don't have any idea where the price might go in the medium to longer term. This could be the start of as I talked about last week, this could be the start of a decade-long bull market in precious metals. One that'll certainly be volatile. If you look at the last one from 2001 to 2011, there was, even though it went up a great deal, there was still a lot of volatility. So you still need to be careful in how you play it. You need to be very clear about how you're playing it. But there is certainly some very strong profits available. All right, turning to other commodities, copper was down just a couple of cents. Crude oil continued to firm, but that's really just coming back from levels that were just insane. We've still got crude oil inventories building, but that rate is slowing. So I guess they're running out of storage capacity, but also production rates have been cut back as well. The demand should pick up because about 3/4 of the world's population, a bit more than 3/4 of the world's population, are in areas that are starting to reopen from the lockdown. So that means that oil demand will go up. So things will get better, but it's really hard to see a return to normal anytime soon. I was of the view that there was a trading opportunity in the sector, and it showed a little bit of momentum for a week or so, but that momentum's been lost again. So I've abandoned that thought in preference to just staying with the stronger stocks. Let's just go with what is. There's the spot copper chart, and to wrap it up, we live in a dramatically changed world. Whether it goes back to the way it used to be is open to debate. But there's no question we are in a very, very different world. But look, one thing never changes. The self-interest of major players never, ever changes. And if you can look at the market action through the eyes of self-interest, through the lens of self-interest, then you've advanced your cause enormously. Because there's a lot of things that are going on in the market at the moment that defy logic. They make no sense. And that's because there's a lot of things going on that are being engineered by the major players. So whether that's right or wrong is not the point. Our task is just to hang on to their coattails and go with them, because there's a lot of money to be made if you can hang on to their coattails well. So forget the old established rules and relationships, because a lot of them just don't apply. They don't make sense anymore. And we may never go back to those sort of rules and relationships. If you're not using charts to a very great extent to dictate your buying and selling, then, frankly, you're not playing in the right game. You're at a significant disadvantage. If you're just using fundamentals or, buying into long-term sectors that you think should do okay, then you're just in the wrong game, and you really need to rethink your whole approach. Portfolio analyst this week, it's just going to be continued focus on entry and profit-taking technique. The opportunities are there. There are hundreds of them. You've just got to have clarity around your game plan for how you get into them, how you take profit, and how you manage them along the way. And I'll also be obviously covering precious metals, both local and the US. That was a massive move on Friday night, and there's certainly some very, very good things to be taken advantage of in that sector. So that's it for this week. If you want to find out more, there's plenty of information on the website, and you can also contact me on that email address. That's it for this week. Cheers.